I'm Jordan Hucht from Vision Wealth Partners, and today I'm going to discuss a relatively new financial planning opportunity, the 529 to Roth Rollover, which is a product of last year's Secure 2.0. Before passage of Secure 2.0, options for leftover 529 account balances were limited. Essentially, the owner could 1. Change the beneficiary to another family member, 2. Take a non-qualified distribution of the account balance and thereby incur taxes and penalties, or 3. Kick the can down the road and hope that a future opportunity will exist to address the educational needs of the beneficiary or a family member. But now, the ability to roll 529 funds to a Roth IRA can be a useful option to handle unused 529 funds. In fact, it may be the most impactful planning opportunity from Secure 2.0. Rather than finding an education-related use for the funds or taking a tax hit, the owner will be able to provide the 529 beneficiary with continued tax-deferred growth of the funds, and in most instances, tax-free withdrawals of the balance. Of course, there are limitations on 529 to Roth rollovers, so let's review them. First, the recipient Roth IRA must be in the name of the 529 beneficiary. Next, the 529 plan must have been open for more than 15 years. Also, rollover amounts cannot include any contributions to the Roth IRA or any earnings on those contributions within 5 years of the rollover. And finally, rollovers are subject to a $35,000 lifetime maximum. It's important to note that Roth IRA contribution limits and rules still apply, with one major exception. Accordingly, a one-time rollover of the entire $35,000 lifetime maximum limit will not be an option because the annual Roth IRA contribution limit, currently $7,000, still applies. Therefore, to use the entire lifetime limit of $35,000, the owner will need to effectuate the rollovers over a period of years within the annual Roth contribution limits. In addition, taxpayers would need to be cognizant if the beneficiary contributed to a traditional or Roth IRA outside of the 529 during the same tax year, because the annual contribution limit is the aggregate of all contribution. In other words, the 529 to Roth rollover does not carry with it an independent limit. The beneficiary must also have earned income to support the Roth contribution. Therefore, rollovers to Roths for minor beneficiaries may not be available unless such minor child has earned income themselves, for example, a child model, lawn mowing, babysitting. There is, however, an important Roth contribution rule that is inapplicable to the new 529 to Roth rollover opportunity. In 2024, an individual's modified adjusted gross income must be less than $161,000 or $240,000 for married filing jointly to contribute to a Roth IRA. That limitation does not apply to 529 to Roth rollovers. Therefore, even high earners who are normally restricted from using a Roth IRA may have the opportunity to get funds into a Roth, much like the backdoor Roth IRA conversion. Although the new opportunities presented by this legislation are exciting, confusion persists in certain areas. For example, with the 15-year clock, what is the effect of changing a 529 plan beneficiary with regard to the new 529 to Roth rollover rule? This is an area that the text of Secure 2.0 did not specifically address. The major concern is whether the change in beneficiary or rollover of funds from one plan to another restarts the 15-year clock, or whether the ability to roll over is tied to the original account opening date, irrespective of any beneficiary changes in the interim. Clarity on this unknown item is essential for a few reasons. Number one, given the 15-year wait time, some individuals could choose to open and seed fund a 529 even prior to having children to start the 15-year clock and later change the beneficiary to a future child. Number two, if a change of beneficiary does not affect the 15-year rule, then theoretically, an owner could complete Roth rollovers exceeding $35,000 from an account by changing the beneficiary. Third, changing beneficiaries of 529 plans is common for families where money needs to be allocated to a different child for educational costs based on disparity of expenses or the educational needs of the child. Ideally, clarity on this issue will come in the form of issuance of guidance from Congress or the IRS on the specific effect of a change of beneficiary on the ability to do a 529 to Roth rollover. Given the significant delays in the issuance of regulations related to the original Secure Act and the persistent uncertainty as to the application of its provisions, it's not certain when to anticipate clarity. As with all financial planning decisions, it's important to understand the rules and limitations of the 529 to Roth rollover opportunity to be able to determine whether it's a strategy that should be considered for your particular situation. For more videos on a variety of wealth management topics, head to our YouTube channel or subscribe. Thanks for watching. I'm Jordan Hucht from Vision Wealth, your dedicated wealth management partners.